How serious is our inflation problem? Is this going to become a full-fledged crisis, and what can we do about it? This is the theme of our discussion with Diego Parrilla. He is a managing partner of Quadriga Asset Managers. He is also the author of The Anti-Bubbles, Opportunities Heading into Lehman Squared and Gold's Perfect Storm. Diego has had over 2 decades of experience in the commodities space, having held senior positions at JP Morgan, Goldman Sachs, and Merrill Lynch, and also on the buy side, including firms like Bluecrest. We'll be talking about all things inflation, macro, and gold with Diego today. Welcome to the show, Diego. It's your first time on Kitco. Pleasure hosting you.
Thank you so much for having me, David. It's a pleasure.
All right, I want to start by talking about inflation now. You wrote in your newsletter that inflation is going to become a very serious problem, and I'm just going to quote you here. The inflation crisis is putting enormous pressure on food, energy, and the cost of living in general, which is likely to result in labor strikes at best and possibly riots, civil wars at worst. Let's talk about that. Very strong words. What do you mean by that, and which economies are you referring to exactly?
Well, look, I think the underlying thing is that over the last few decades, we've lived with this misconception that when you have problems, you can solve them through printing money and debt, basically monetary and fiscal policies. My view is that, I'm sorry to say, you're not going to solve the problems. You're going to do a few things. You're going to delay the problem first. You're effectively kicking the can down the road in the form of spending and debt. You're passing the problem to the next generation. The second thing you're doing is you're transferring the problem. This is in the form of currency wars and trade wars. The third thing, which is what you mentioned, is you're transforming the problem. So you might be printing money, which effectively creates a lot of dollars or euros, and basically your purchase power diminishes, and ultimately you create massive distortions with things like zero or negative interest rates and excessive liquidity, which create bubbles that are too big to fail. The problem we have is that as the bubbles become systemic and these misconceptions are exposed, central banks are likely to be forced to respond with more of the same. And more of the same money printing means that effectively the value of your money goes down. So it's important to understand that inflation is not so much about the value of my house going up or the value of bread going up. It's really about the value of the money with which you buy your house and bread going down. And you don't need to be a rocket scientist to know that if you print trillions and trillions and trillions of dollars out of thin air, the value of your money is going to be going down. So what we're seeing, it's a global problem. Inflation, the official inflation versus the real inflation that we experience, is resulting in increasing prices that largely outpace our income. So effectively, we're becoming poorer and poorer in real terms. If you're very rich, and then it's not an issue. If you are in a different situation, and those price increases mean that you're not able to feed your family or pay your rent, this becomes effectively a major problem. And so what I'm saying is not a pretty picture, but it's not new. I mean, we've lived through these kind of situations in the past. And when I dedicate my book and I give the outlook, the anti-bubbles, I've always said, I hope you like it. I hope I'm wrong. I feel a bit like a doctor that is diagnosing a terrible disease to a friend. Look, as a doctor, I want to be correct. As a friend, I hope I'll be wrong. And I think a lot of the policies, I would say reckless, negligent policies have led to inflation, and this is a really big issue.
I want to come back to gold and the capital markets, but just on your point about inflation becoming a social issue, I want to read you this article from CNBC just 2 days ago. Nearly 70% of Americans are looking for extra work to combat inflation, and the title basically states the story. A lot of people in the U.S., this story focuses on the U.S., are looking for ways to earn extra money on the side to fight inflation. What are the long-term societal impacts of sustained inflation on developed Western countries, do you think?
Look, there's been often the debate on whether the world was becoming Japan or Argentina. Mm-hmm. And I think, unfortunately, we're heading more in the Argentina way. So you have, or Venezuela. So what you have is basically governments that don't want to face the problems. There may be the next election, maybe naively think that, everything becomes an emergency, right? Every single thing. Of course, pandemic was tough, but the monetary and fiscal responses are effectively creating these major imbalances. So when you look at the situation in inflation, inflation has two dimensions. The first one is inflation per se. It's like, 2 + 2 = 4. You dilute your dollar, it buys you less. But the problem with inflation is the second part, which is inflation expectations. So a good friend of mine from Argentina, would tell me, Diego, 5% inflation a year is not really a problem. The problem is when you move into 5% per month. Yeah. This is when you start to change your habits. Those shoes that you were into buy, you need to buy today, things start to accelerate, and this process effectively leads to huge instability. So ultimately, inflation creates poverty, and you just need to look at the many countries in the world that have suffered. So I know it sounds a bit extreme to think that the West will face this, right. But at the same time, the kind of monetary and fiscal abuse that we've been able to do would have certainly not been forgiven to any of those countries. So I think we're in for an interesting ride.
Well, Diego, so you said that inflation leads to poverty. That's assuming my living standards don't keep up. Let's assume, for the sake of argument, that we have 5% inflation a month, but my wages rise by 6% a month. I'm okay, right? Could that happen?
Yes. Unlikely, but yes, it can. It depends on the sources of. So let's say, I would define there's, let's say, good type of inflation and bad type of inflation, and different. It takes many forms. So if the world is a great place and we're all doing super well and we want to buy great houses and it's all real growth, you would have a cyclical movement, and houses go up and then perhaps they go too high and then they go down. But this would be part of a normal behavior. The problem with the bad inflation is that you're just really introducing factors such as money printing that have nothing to do. It's not real. They create wealth effect. They create bubbles. They create distortions. And ultimately, I think the problem is the bad inflation does not have that counter of higher wages. Good luck negotiating your 6% with inflation at 5. It's extremely unlikely that you're going to keep up. And bear in mind that I use this analogy, what I call the frogs in boiling water, right, to explain a little bit the dynamic. I use it because we're all frogs in this monetary broth, right, where for decades the temperature has been increasing at 2%. Now, 2% is scientifically calculated so that on the one hand, it's small enough that we don't really notice, we don't jump. But it's high enough that compounded over 10, 20, 30 years, it boils you to death. Think about the compound effect, 2%. Of course, what's happening now, it's a completely different dimension. We're talking about inflation at 8, 10+%. The frogs can see and feel clearly the rise in temperature, and we are jumping off the water, right? And the inflation expectations that are coming are accelerating the process. So the amount of purchase power loss, if you compound at 10% over a few years, you realize that you end up, effectively not being able to buy pretty much anything at all. And this is the dangers of high inflation and why the central banks are finally, reacting to this issue and having extraordinarily aggressive hikes at a pace and size that we haven't seen almost ever. And this is, in my view, the admission of their own, and I'm going to call it negligence or incompetence, by effectively ignoring what we all knew was a major problem in the making.
Okay. All right, Diego, so let's talk about central bank policy now. That was a very good segue. Just yesterday, the Bank of England released a statement. I'm just going to read the first paragraph. The bank will carry out temporary purchases of long-dated UK government bonds from the 28th of September. That was yesterday. The purpose of these purchases will be to restore orderly market conditions. The purchases will be carried out on whatever scale is necessary to effect this outcome. Diego, it sounds to me like they've pivoted. They've stopped quantitative tightening. It lasted only, I think, less than a year. And now they are going back to QE. These words are strong. whatever scale is necessary to affect this outcome. Why are they doing this?
Well, look, I think the situation got at the technical level. It got really tricky. Some people are describing the price action of the last few days almost as a quasi Lehman moment. I mean, you have a situation where the sterling pound on the news of tax cuts and fiscal expansion in this environment was not really welcomed by the market, and basically you have the synchronous sell-off in the currency as well as a massive rise in yields. So together, this created huge losses in many investors' portfolios, including pension funds, some of which were being margin called. So you have a situation where as these things get triggered and they get disorderly, they kind of feed on themselves. So the actions from the Bank of England are a response to this risk of things getting effectively disorderly and triggering the collapse of big pensions and other players. Mm-hmm. So ultimately, I think this shows the challenge and the trap central banks are in between having to fight inflation on the one hand, having to live or avoid the collapse of the bubbles they themselves created, and do that in a way that you're sort of keeping the economy going and etc. So I think the UK has been behaving much more like an emerging market recently, and that kind of feeds into the discussion earlier, where the Western world has been moving into more of an Argentinization rather than the other way.
Okay. And do you think that what the Bank of England is doing is particular to just England? In other words, do you think the Federal Reserve in the United States could follow their example and start pivoting very soon?
Look, I think if you look at the central bank community, there are, I would say, three big groups. We have, on the one hand, the Federal Reserve, which is a central bank that has been hiking aggressively. Arguably, they are in a strong position of growth, of markets, of labor, of even energy markets. And so they're going ahead with that. The impact of their hikes, we've already passed the 2.5% mark, which is when the system cracked in Q4 2018. And something is bound to break, whether it's in the US or outside. The second group of central banks, which is where Bank of England, European Central Bank, and Japan stand, they're in a way almost hiking reluctantly, or doing things that, on the one hand, the ECB, I think, is a case study where they're hiking interest rates with the acknowledgement and realization that zero or negative nominal yields was a mistake. I think we will live in a world of positive nominal yields. The problem is that, as I said earlier, this might trigger hikes or higher yields in the debt, and then people like Spain or Italy or others will have trouble paying for the debt. So whilst they're hiking rates, i.e., putting the foot on the brake, they're also pushing the accelerator by saying, look, I'm going to keep printing euros to basically subsidize this and prevent the collapse of these bonds. And I think this is the direction we're taking. The third group, people like China, are in a very different macro situation. They're already, in my opinion, in serious trouble, and they're actually easing. So monetary divergence, it's a key theme that is driving currencies, rates, volatility, inflation. And like previous currency wars, what you see is a stronger dollar is actually welcome by the Fed. Historically, you would like a weaker currency so that, I'm more competitive. You send me your money, your technology, your savings, your labor, your taxes. Now it's more about, look, a stronger dollar will let me export inflation. And we're seeing the pain. We're seeing 3 central bank interventions basically in a week. Japan, Bank of England, and this morning, China. So the weakness of the currencies is starting to hurt also through the inflation channel. Bad news for all these central banks is that these interventions are unilateral. Japan, the last intervention was 24 years ago, and it was more successful because you had all the central banks, including the Fed, coming in one. the fact that these guys are doing it unilaterally and arguably not succeeding in a big way, I think actually might backfire as well. And because they are starting to use very valuable bullets, called dollars, which they have limited quantity and access to.
Okay, and let's move on to capital markets then. So, as you know, the gold price has been falling. 1650 is the latest price. What is your outlook given everything we've discussed?
I'm constructive. I think there are assets that obviously I don't have a crystal ball,
Yes.
and I have nobody does. But there are assets that in the short term you could expect, that negative trend to continue. But in fact, it would be very, very bullish. I think oil is one of those cases. You could see how the recession actually brings it lower, only to be much, much higher in the medium term. I actually think gold prices, it's very hard to call the bottom, but it's been an incredibly difficult year for gold investors. Many of them may even thrown the towel. I remain very constructive for the wrong reasons, unfortunately, which is more printing, and more credit defaults and more inflation and more volatility. And I think gold is, alongside the VIX, an asset that has been neglected recently by many people. And I think it's in a strong position to actually come back with vengeance. And under certain scenarios, I think it could be extraordinarily, the price up could be very, very strong. But these are scenarios that unfortunately, that all of us don't want, such as, an escalation in Russia and the risk of nuclear, which unfortunately since last week is taking a slightly higher probability than we all wish it had.
Let's talk about that briefly. The war in Ukraine, very important for all capital markets, especially gold. What happened last week exactly, and why are you concerned?
Well, basically, you have Vladimir Putin coming with a televised speech where he made a few very, very big points. The first one was he sort of tendered the line to Ukraine saying, look, we were going to negotiate peace, and the bad guys from the West said that they shouldn't come to agreement. So the second thing that he said is the West is actively helping Ukraine. So effectively, the conclusion from those 2 points is war is no longer against Ukraine, war is against the West. The next thing that he's doing in an effort to consolidate or justify or save face is we're going to run referendum in 4 regions. I think just staying put with what he had before the war would be just incredibly bad. He needs to justify this thing by something more. And the fine line and the big problem here is that once those referendum are completed and Russia believes that is effectively Russian motherland, any attack on those will be an attack on Russian motherland. And then he says we will use whatever tools we have, and he mentioned nuclear. So as a step from the acknowledgement that the war has stepped up and is no longer Ukraine but is the West, he's beefed up and called 300,000 soldiers.
Yes.
But the worrying thing is, at what point does he consider these regions motherland and the use of nuclear justified? And I think as the pressure increases, both domestically and externally, the room for miscalculation or errors increases, and that's something we should be worried about.
Putin doesn't usually or regularly make TV appearances. And in fact, everything that he said that you recapped for us, he could have just kept to his own advisors. He didn't need to say those things on TV. Why did he make it a public appearance?
Well, his status, political figure, is been super high prior to the war. I think the situation right now, I'm not in a position to judge. Obviously, Russia is a very large country, and there's people with opinions on both sides. I think his approach with the rationale and arguably, by controlling the message. I honestly don't know exactly what people are having access to, but to be able to send this message, I'm sure some people are. It's a way to get that national support. And put it differently, I don't think he could do what he's doing without having this approach. I think you can be opaque. So he's rightly or wrongly, stating the facts and stepping up, not just the rhetoric, but also the actions and the threats.
Well, this is definitely a developing story, so we'll keep tabs on that. Thank you, Diego. And final question for you. You've mentioned that the West could be potentially heading into an Argentina-style environment. If that is the case, what are the best ways to hedge against sustained inflation?
Well, I guess the conclusion and the big debate in the market now is we all agree that central banks are hiking nominal rates. We all agree, perhaps, that these hikes will result in inflation coming off. In some ways, for the wrong reasons, because you get recession, you get things, credit defaults, destroy demand, weaker currencies. So in that sense, we probably agree that rates are going up or have already gone up, and housing market. There's many things that will result in short term. Now the big question is what's next? Are we going to stay in a world of positive real yields, or as many smart people think, and as the market is predicting today, or is that response and that crisis going to require further responses such as yield curve control and more printing? In my view, that monetary response will be needed, and that means that inflation will be substantially above nominal rates. So my view is not very positive on growth and not positive on inflation. So my base case is more of a stagflationary scenario. And in that sense, you need to think about not only what works, but more importantly, what doesn't work. And what doesn't work is, unfortunately, cash, fixed income, or credit, which are assets that are effectively short inflation. Because if you bought a bond, that you spend 100 euros or dollars for something that is going to give you back $100 or 101 in 30 years, my view is those 101 euros or dollars in 30 years are going to buy you nothing. So the game has changed. Once upon a time, and over the last few decades, we've played this game in nominal terms. We looked at our investments thinking, oh, I have $100, I want to make them into 105, 107, whatever. This was possible because inflation was negligible. The game has changed, and now, if you're making 2, 3, 4% on your money, you might look good and then realize, oh my God, inflation is 10%. I actually lost 5, 6%. Yeah. So I think high sustained inflation means us investors will start to change the way we think about money. We'll start to think about money and return in real terms, i.e. net of inflation. And that is effectively good for real assets. Things like gold actually benefit, real estate, land, etc. Equities are obviously on paper, a better way to access the risk markets than credit. And I think this is the new paradigm. I often use the analogy that a portfolio is like a soccer team, like a football team, and you need strikers, midfielders, defenders, goalkeepers. And I think in that scenario, you have two dimensions. The assets, how they perform relative to volatility and risk. You need to be very diversified. Yes. It's no longer good enough to have only strikers. You also need defenders. And the other dimension is inflation. So I think my view is it's going to be a very volatile environment with tail risks in both directions. You will need a very truly diversified portfolio. And I think you need a long bias towards inflation, because my view is inflation is structural and will remain high.
That's a good point. I mean, the 60-40 portfolio didn't work this year. Stocks went down. Bonds also went down a lot. So what do you mean by truly diversify? What is the appropriate allocation today?
Well, let me explain what I call false diversification. Okay, when people buy a portfolio, they confuse a very simple thing, which is my portfolio is diversified with my portfolio has a lot of things. I'm sorry to say, a portfolio with a lot of things is not necessarily diversified. Okay, I'll use a bad example, but if you bought 20 cryptocurrencies, I'm sorry, mate, you're not diversified. Okay, you have just one trade. So I think the false diversification tells you, well, I thought I was diversified because I had bonds and equities and whatever, and turns out that this is not a game of average correlations. It's not a game of how things do during normal times. It's how do you do in a crisis. And the problem we're seeing is that when the crisis hits, many of your assets that seemingly looked uncorrelated actually behave like the same thing. And this is where strategies like what we run, effectively are designed with this anti-bubble framework to effectively create truly negatively correlated performance. And this comes from being long volatility or being long defensive assets, such as recently the dollar, or, in my view, gold, inflation, and others. So I think this is very important, and I think investors should beware of false diversification and the hidden leverage that it creates in portfolios, because you're running a lot more risk than you actually thought.
I understand. So final point, I'll let you go. Since you brought up cryptocurrencies, should you have cryptocurrencies in your portfolio as a diversified asset? I saw that face you made. I think I know the answer, but I'll let you explain.
No, look, I wrote a lengthy article a long time ago called Bitcoin Bubble or Anti-Bubble. I basically started with some lines with Frida Kahlo, which is, I don't want you to think like me, I want you to think. And I laid out a lot of the arguments and in favor and against. My conclusion was that the crypto space is 80% of a bubble, 20% anti-bubble. I hold my view. I think that I'm a huge believer in technology. Don't take me wrong. I'm an engineer. My energy book, it's all about the power and the transformational power of technology. But that doesn't necessarily translate into good investments or other things. There are many considerations. It's not a one-way street. I've studied a lot of history. I know how the governments and central banks will operate. I understand also Ponzi's and bubbles and misconceptions. And I think that investors should be very careful. Everyone's free to do what they want, but certainly, I think if you sell your house and go all in, this is a terrible decision. So, like everything, leverage is your biggest enemy. If people want to be long, they should do it in the right size without leverage, and time will tell. But I personally think that there are other ways in which, including gold, that I think are better plays over the long term.
Diego, thank you so much for your time today. I appreciate your thoughts, and welcome to Kitco. I hope to speak to you again soon. Thank you.
It's been my absolute pleasure. Thank you, everyone, and thanks for hosting me, David. All the best.
All the best to you as well, and thank you for watching Kitco News. I'm David Lin.